All in all, it was a solid jobs report for the economy. Between jobs growth and stock market and wages on the rise, the economy is on solid footing. But what does 2008 have for the economy and the markets? Chase economist Anthony Chan kicks us off right now to talk more about that. And Anthony, it's good to see you this morning. Thanks so much for joining us.
Good morning, Maria.
Give me your take on the jobs number that we saw on Friday and how the economy is shaken out as we kick off a new year, 2018.
Well, Maria, this employment report was actually pretty good because everybody's concerned that the economy will overheat, will have a lot of inflation, and the Federal Reserve will start raising rates very aggressively. But we didn't see that. We, in fact, continue to see wages rising, as you indicated, now up 2.5% on a year-over-year basis. We got a slight downward revision in the prior month, but this number is not necessarily a bad thing because it means no overheating. In terms of job creation, we continue to create jobs. We've now had 87 consecutive months of positive job gains. That's pretty impressive. We haven't seen that in many, many decades, over almost 80 years. So that's a very, very good number. And then in terms of the unemployment rate, it didn't go down, but we're still creating jobs. And one of the reasons, believe it or not, Maria, is that you were talking about the hurricanes. Hurricane Maria is causing a lot of people from Puerto Rico to come to the United States. Already, some estimates suggest about 250,000 people have come into the United States. And that means that we get an additional push or an increase of workers into the labor force without necessarily pushing wages higher, because obviously they're very anxious to get these jobs. So that, I think, is actually helping and creating a little bit more space for the Federal Reserve to continue to raise rates, but not at a very fast pace that would cause the economy to slow down. Yeah. So I think this is a very good report.
There's a lot of implications as a result of this report that I want to get to. You mentioned wage growth and the Federal Reserve. That's one of them. Also, the job creation that we saw. I mean, most sectors actually saw job creation with the exception of retail. So do you want to invest along those lines? You saw construction jobs up, manufacturing jobs up, certainly services jobs up, not retail. Is that where you want to allocate money? What are you telling clients in terms of what this report means for investing?
Well, I think this report tells us that the economy is continuing to grow. We're going to see fast growth. I mean, the Atlanta Fed is already projecting economic growth in the fourth quarter of about 3.2%. The number may ultimately come in a little bit lower, but something close to 3%. That's a very, very good number. We now have a tax package that will stimulate economic growth in this year, in 2018. That's very positive. Yes, the Federal Reserve raising rates subtracts a little bit. On a net-net basis, I still think it's very, very positive. So what sectors do we like? We still like the technology sector. We know that the regulation is continuing to go down in the financial sector, so we're very excited about the financial sector. You mentioned some of the job gains. The healthcare sector created 30,000 jobs. We're very bullish on the healthcare sector at this time. So there are a lot of sectors out there that continue to do well. And if the economy does well, we're going to see that the industrial sector, a lot of the cyclical sectors will do a little bit better. Some of those sectors that are related to rising rates and will have a negative impact, like real estate. We, in fact, have seen the real estate sector losing a little bit of momentum. Some of those defensive stocks, like the consumer staples and maybe telecom, not as exciting. But there are a lot of sectors out there doing well. And believe it or not, Maria, let's not forget that the international equity markets are also exciting, which we're telling our clients to be excited about. When you look at bull markets without necessarily encountering a bear market, when you look at, say, the European equity markets, the Japanese equity markets, and even emerging markets, they're basically in line with what we have seen historically. The U.S. equity market, if you look at our bull market relative to the time that we haven't seen a bear market, it's about 3.4 times longer. But again, the fundamentals are getting better. But bottom line here, Maria, these other markets, international, seem to be even a lot less overextended than U.S. equity markets. So we think investors should also be paying attention to those markets.
That's a really good point. Anthony, always a pleasure. Thanks so much.